Hey, what's up everyone? It's Griffin here, and like I was just mentioning on the street there, well in today's video we're going to be speaking about how individual investors like you and I can actually invest into commercial grade property directly from your stock market account with what's known as a real estate investment trust, or REIT for short, which you can think of as a large fund that owns a ton of real estate, but shares of the company are public and trade on an exchange just like basically any other public company. So this obviously comes with different pros and cons, which yes, we will be speaking about, but I really wanted to get everyone up to speed with real estate investment trust and how you can actually approach them and invest in them if you're new to the space and want some further diversification in your investment portfolio for exposure towards real estate. And by the way, if this video gives you any value whatsoever, make sure to drop a like, it really helps the channel out. Alright, so first things first, why should you even care about REITs as an investor, right? Well, like I mentioned, REITs are publicly traded real estate funds that often purchase tens or even hundreds of millions of dollars worth of real estate assets, which are then managed by the company in question. But as investors, well, we can pick up shares of these REITs on public exchanges, just like you would shares of, say, Google or Apple. But this allows investors to gain exposure to the real estate market and industry without having to go and physically purchase real estate assets yourself. And considering the fact that real estate as a whole is one of the largest industries worldwide, well, it makes sense that in North America alone, there are over 250 registered REITs to choose from that trade on public exchanges. In fact, there's around 35 in Canada and around 225 in the United States. Now, you might think that REITs are all cut from the same cloth. After all, they all purchase and manage real estate, right? But in reality, well, each one is of course an individual company, but they can also further differentiate themselves from one another by actually purchasing and specializing in certain sub-facets of real estate assets in question. For example, here are some of the main categories of real estate assets that REITs will typically invest in. So first off, we have residential apartment buildings, followed with commercial office buildings, commercial retail establishments like malls, as well as retail complexes. Then there's also industrial real estate, which includes logistics centers as well as warehouses. Some REITs will also invest specifically in medical establishments. And then finally, we have hotels and resorts. Now, most REITs will actually specialize in purchasing and managing one of the above mentioned classes of real estate investments, but some will actually invest in a mixture and variety of each, which as an investor could be beneficial if you want exposure to multiple different types of real estate investments. So that pretty well covers what an REIT is. If you have any additional questions, make sure to comment down below and I'll be sure to answer any question that you might have. Now, let's actually speak about why investing in REITs could be beneficial to stock market investors in the first place. If you're a homeowner or own any other real estate assets, then chances are when you went to purchase the property, you actually had to go through many different hoops in order to acquire it, like research, speaking to a realtor, speaking to a mortgage broker, inspecting the property, and also having to fork up a substantial amount of cash for the down payment and all of the other closing costs. And don't get me wrong, I'm a massive advocate for property ownership, right? This house I own, and over the past 3 years or so, I've purchased around 10 rental properties that have multiple units in each one, right? And so for this reason, I really think most people and most investors should actually try to become physical real estate investors over time if possible. But the reality is that real estate investments do have a much larger moat to enter. They require a lot of capital, your liquidity isn't as easily accessible, and typically it's quite a bit more of an active investment than any type of stock market or paper asset. And so this is where paper real estate, as I like to call it, comes into play, like real estate investment trust, as well as other forms of, say, crowd-funded real estate that you can do through the platform called Addy in Canada, or like Fundrise down in the United States, which are a lot more accessible for investors of all skill levels, as well as investors that have various different types of capital to invest with. First of all, real estate investment trusts offer investors much higher levels of liquidity to their investments than holding, say, physical real estate, because shares actually trade on public exchanges, meaning every single day thousands of individual investors are buying and selling shares of these specific companies. And investment liquidity really just comes down to the ease at which you're able to buy and sell shares or offload your investment. So if you own, say, some rare collectibles that only 5 people in the world are interested in, well, your access to liquidity is quite a bit lower than than if you own shares of a stock where hundreds or even thousands of people are shareholders and actively buying and selling on a daily basis. So yeah, that really is one of the main advantages of REITs in terms of real estate exposure than holding physical real estate, even though physical real estate has its own set of pros and cons. But when it comes to, offloading a property, even though right now in the current market, properties are selling themselves in a matter of a couple of days, well, that isn't the traditional narrative, and you can't just offload shares of, your house in a matter of a couple of seconds, right? So if we take a look at, say, RioCan, which is a large real estate investment trust here in Canada, well, it has a market cap of around 7.5 billion. So we're talking about a very large company here with a lot of liquidity in it, and the bid to ask spread is extremely tight, meaning you can buy and sell shares without risking losing large amounts of your capital due to low liquidity as well as low volume. Now, one of the next advantages that typically comes with owning shares of real estate investment trusts is the higher than average level of dividend income that you can expect from these positions. And the reason for this is because, legally speaking, in order for a trust to be considered an REIT and maintain that status, well, they're obligated to redistribute a high portion of their net income back to shareholders in the form of, you guessed it, dividend distributions. So just like with any other dividend stock like Pepsi or TD, for example, that usually have higher and consistent dividend income that investors rely on, well, with a real estate investment trust, these are also known to have higher than average and consistent dividend income as a result of this rule that they have to follow. Of course, though, like with any other dividend stock, there are some things that you're going to want to look into and research before pulling the trigger on, say, a 15% dividend yield REIT, but we're going to be covering those after speaking about Wealthsimple Trade that was awesome enough to sponsor today's video. All right, so as you're now aware, REITs trade on stock exchanges, meaning you can buy and sell shares of your favorite real estate investment trusts directly from your mobile phone if that's where you trade stocks like I do. And whether or not you're trading REITs, individual stocks, or ETFs, all of this is made super easy with Wealthsimple Trade. Wealthsimple Trade is Canada's low-cost investment brokerage that allows you to buy and sell Canadian positions completely commission-free, and they've also recently launched a Plus subscription, allowing investors to hold USD in their accounts. And what's great about Wealthsimple Trade is that it literally takes less than 5 minutes to create an account, and you can start investing right away with as little as $1. So it's just great for beginners and any other investor who understands the importance of saving on commissions, which really eat away at returns over years of investing. I've personally been using Wealthsimple Trade for the past several years. The platform's just really sleek and intuitive to use, along with the low commissions, of course. So if you're ready to start investing in your own financial future, make sure to check out Wealthsimple Trade today. There's a link down below in the description, and if you use that specific link to sign up, you'll get 3 free stock rewards, each valued up to $4,500 a piece. Thanks again to Wealthsimple Trade for sponsoring today's video. It's really through opportunities like these I'm able to continue making videos for all of you to enjoy. All right, so before we jump into how to go about investing in REITs, it's important to first cover some things to be aware of and what to consider when determining whether or not a real estate investment trust is suitable for you and would represent a possible good investment. So typically you'll want to see with any real estate investment trust that you're considering consistency in dividend payments as well as increases of those dividend payments over a several year period, at a minimum usually around 5 years, but the more the better. This really just shows us that the company has managed to maintain their dividend payments over a long enough period of time, and also that they have a continued focus on those dividend distributions for shareholders. Now, another metric in relation to the dividend distribution of an REIT that we want to look for is the dividend to funds from operations payout ratio, right? The dividend to FFO payout ratio. It sounds really complicated, but it's not, right? When we're looking at any other dividend stock, you'll typically be looking for a dividend to net income ratio where around 50% or lower tells us that, well, the company is in a healthy position to maintain those dividend payments. In regards to a real estate investment trust, though, well, the net income doesn't really give us the full picture because actual asset value increases and decreases comes into play in regards to the net income. So looking at the funds from operation, which pretty much strictly takes into account the actual net rent of a fund, gives us a better picture of the health and sustainability of their dividend payments over time, and it's completely normal to see higher dividend to FFO ratios in around the 75% range. For example, if we look a couple quarters back, this is why the net income of many real estate investment trusts like this one were extremely high for some quarters. It's because there was an adjustment of the market value of their real estate holdings, and so this is directly applied to their net income. But of course, this is kind kind of like a paper gain. It's not a real gain in net income, but can highly skew the net income as well as net losses potentially of a real estate investment trust. The next thing we want to see in a real estate investment trust that's growing is growth in the total net assets under management, and not just the actual market value of the holdings in question, the actual number of property acquisitions as well as units under management of the company in question. Because again, the organic growth of an REIT is mainly attributed to two factors. The first one being optimization of current properties, so increasing rents over time, tenant turnover, as well as renovations that can add value to the properties. And the second way is through acquiring or building more properties to add to the portfolio and increase total income over time. If you're wondering where you can find all this information, by the way, super simple. You can find it easily in the quarterly earnings report of any real estate investment trust. And speaking of financial statements, well, while you're in there looking at the growth in total assets under management, also take a look at growth in funds from operation. Again, this is one of the main values that you want to see in terms of the long-term growth of a real estate investment trust is growth in the funds from operations over time, because this means that the fund is able to continue increasing rents, adding new units, adding new buildings and acquiring them, and then also just charging more from their tenants that are currently in place. Now, overall, real estate as a sector is one of the most stable industries over time and tends to actually follow the inflationary levels when projected over a long enough period. This is the case at least in North American real estate. That being said, targeting real estate investment trusts that invest specifically in certain sub-facets of real estate could potentially provide you with higher levels of returns over others just by the nature of the real estate assets that they're purchasing and operating. For example, residential as well as industrial properties are seeing massive increases in demand resulting from population growth in urban areas. In fact, as a result of this, these are the facets of real estate that I'm personally trying to target through, yes, my own physical properties that are basically all residential right now, but then also through my other real estate holdings that are more paper real estate assets, right? So for example, with REITs, as well as with other things such as crowdfunded real estate with Addy, I try to target both residential as well as industrial properties because I believe personally that these two subfacets of real estate are really where we're going to be seeing the largest amount of demand and growth in value over the next couple of decades. All right, great. So hopefully that gave you a much better idea of what real estate investment trusts are, how they can invest in different types of property, and really what are some of the benefits of investing in a real estate investment trust in the first place. Now, once you actually understand all of that, going ahead and purchasing shares of a real estate investment trust is really no different than buying stock of any other company. So thanks again to Wealthsimple Trade for sponsoring today's video. If you enjoyed it, by the way, make sure to drop a like. It really helps my channel out. And of course, don't forget to subscribe and hit the bell button to be notified of any new and upcoming investment content that I release. So with that said, thanks for watching, and I will see you in the next one.